session. I'm your moderator Dawazam, and today we will explore why central bank turned to unconventional strategies like quantitative easing, yield curve control, negative interest rate policy, and forward guidance, particularly during crisis when traditional tools and strategies are ineffective. Now I will let the panelists to introduce themselves.
Thank you. And my name is Namu, and I'm an economist from the European Central Bank.
Thank you, and hello everyone. My name is Tikshuren, and I'm the policy advisor in the Bank of Japan.
And I'm Chosun Hamon, analyst at the US Federal Reserve.
Thank you all the panelists.
The US rate dropped sharply during the 2008 financial crisis and again in 2020, hitting near zero, 0.05% in April 2020, and staying very low for an extended period, reflecting the zero lower bound where traditional monetary policy became ineffective. The European Central Bank benchmark rate averaged 1.87% from 1998 to 2025, hitting a record low of 0.00% in March 2016. The European Central Bank introduced negative interest rates and quantitative easing around this period to stimulate the economy beyond the zero bound.
Japan's benchmark interest rate has hovered near zero or negative for much of the 2000s and 2010, with the Bank of Japan implementing negative interest rate policy starting in January 2016 to push rates below zero and stimulate growth. Japan ended its negative interest rate era only recently in early 2024.
The above-mentioned evidences showcases the ineffectiveness of the traditional tools or strategies.
Now let's all begin with sharing on insights on the unconventional monetary policy. Before we discuss on effectiveness, let's understand why unconventional monetary policy became necessary. Let's start with Josephine.
The US Federal Reserve used quantitative tightening and forward guidance in 2023 to 2024, decreasing its balance sheet by $1.5 trillion to curb inflation. While this helped control price surges, it also increased mortgage rates above 7%, slowing economic growth.
Thank you. Now let's go with Vicky.
In Japan, deflation persisted for decades, forcing us to implement NIRP in 2016 and modify yield curve control in 2024, and we allowed 10-year bond yield to exceed 1%, aiming to control inflation, but this led to decrease in yen and also in shift in the export markets. As seen in the graph, Japan's 10-year bond yield remained below 1% for most of the 2024, reflecting our long-standing ultra-low monetary policy. However, after we revised our yield curve control framework, yields began rising sharply in late 2024. By March 2025, they peaked near 1.6% before stabilizing around 1.5%. This policy shift was aimed at tackling inflation more assertively after years of deflation and stagnant growth. While it signaled a return to more conventional policy, the rise in yields contributed to a weaker yen. This depreciation helped exports but also raised the cost of imports, adding complexity to our inflation management. The trade-offs underscored the challenge of existing from years of extraordinary monetary support.
Now let's go with the unconventional monetary policy became necessary when traditional tools, mainly adjusting interest rates, lost their effectiveness. For instance, during the crisis like 2008 financial crash and again during the COVID-19 pandemic, interest rates in the Eurozone fell close to zero. With limited room to cut rates further, we at the European Central Bank had to look for the alternative ways to stimulate the economy. That's why we launched quantitative easing in 2023, purchasing Euro 1.7 trillion in assets to establish the markets.
The chart shows how net asset purchases under the European Central Bank's asset purchase program evolved over time. Starting in 2015, we saw large-scale purchases, mainly government bonds, under public sector purchase program to combat low inflation. Purchases peaked around Euro 80 billion a month, then slowed in 2018 and paused in 2019. But with the COVID-19 shock in 2020, we ramped them up again. By 2022, we started phasing out purchases, and from
2023, we shifted to quantitative tightening, letting assets roll off our balance sheet. That's what the negative bars on the right show. So, this chart reflects how the European Central Bank moved from crisis support to policy normalization as inflation and financial conditions changed.
Thank you all the panelists for sharing your insights. Now let's explore how these policy affect economics globally. Vicky, how did Japan's yield curve control policy shift in 2024 impact the yen?
As of Japan's YCC policy shift in 2024, the yen depreciated by 8% against the dollars, helping exports but making imports costlier. And this reflects the trade-offs of the monetary policy adjustments.
Nurul, how effective was Europe's 2023 quantitative easing program in stabilizing inflation?
It successfully lowered foreign costs, but the inflation remains above 4% in the early 2024. So the key challenge is managing long-term debt risk.
Chosen, as you have mentioned earlier, the Fed's $1.5 trillion quantitative tightening program raised mortgage to 7%. So, what were some of the consequences faced?
While quantitative tightening controls inflation, it hurts housing affordability. Tightening policy must balance inflation control with economic stability.
Critics argued that quantitative easing benefit asset owner over wage earners. So, what's your take on this?
Quantitative easing can boost the stock and property prices, favoring the investors, while borrowing costs drop. The wealth gap can widen unless they properly managed.
Vicky, did negative interest rate policy and IRB successfully increase household spending in Japan?
Not as expected, as many consumers saved more fearing of uncertainty, and moreover, fiscal policy are needed along the NRRP to stimulate the demand.
Choksen, can forward guidance boost effectiveness if market doubt central bank's decisions?
Yes, in 2022, uncertainty over Fed policies lead to market volatility, so maintaining consistency, transparency, and messaging is crucial.
We have explored the fundamental aspect of unconventional monetary policy, but now let's dive deeper into its broader implications. While this policy were designed to stabilize economies during crisis, long-term consequences such as financial distortion, inequality, and policy credibility deserve further scrutiny. Choksen,
Forward guidance affects expectations, making it a powerful but a fragile tool. So if central bank loses credibility, its signals may backfire, triggering market volatility. The Fed's communication slips up in 2022 when inflation was misjudged as transitory, which leads to rapid and painful corrections. Hence, central bank needs transparent and data-consistent messaging to maintain their authority.
now Vicky.
Unconventional monetary policy has mixed effects socially, but NRRP and quantity easing trained to benefit asset holders over the savers, increasing their wealth inequality. And in case of Japan, many households saw real income statements, even the stock price rises. And socially, that can lead to weaken the central bank, trust in central bank. And it shows that the monetary policy alone cannot face the inequality issues, but it also needs the help of the fiscal policy to play a role.
Thank you, Vicky. Now to on with the group.
Unconventional monetary policy can be a powerful tool to stabilize the markets during the crisis. Quantitative easing, for instance, successfully lowered yields and kept restraint after the Eurozone debt crisis again during the pandemic. However, these tools distort financial markets if used too long. For example, prolonged quantitative easing in Europe led to mispricing of rates and suppressed bond yields, making it harder for pension funds to meet the obligations.
Thank you, Susan. Nurul, has quantitative easing leads to financial bubbles?
Normally, there is a debate around this. So, quantitative easing can push asset prices up, and excessive reliance on it can lead to speculative bubbles. We must balance market stability with preventing distortions.
Now, Vicky, does negative interest rate policy create risk for banks?
Yes, lower interest rate squeezes bank profitability. That's why Japan adjusted yield curve controlled instead of depending on negative interest rate policy further.
Now, Joseph, can central bank regain trust after unconventional monetary policy missteps?
Forward guidance play a key role, so consistent messaging and clear frameworks help restore credibility when policy changes create uncertainty.
Now let's move our discussion to small economies like Bhutan. Which unconventional monetary policy suits small economies like Bhutan, given their limited financial markets and unique economic structures?
Quantitative easing is least feasible due to Bhutan's limited bond and capital markets. Instead, the country could adopt targeted lending schemes such as India's emergency credit line guarantee scheme, which helped small businesses recover post-COVID.
Thank you. Now Diki.
I agreed. Negative interest rate policy may not suit Bhutan, where the financial inclusion is still growing, and instead sector-specific liquidity supports like concessional routes to the agriculture or tourism could stabilize the employment and output.
Forward guidance could be a cost-effective options, even if Bhutan lacks large financial markets. Clear communication from the Royal Monetary Authority (RMA) on policy intentions like inflation or exchange rate targets can shape businesses and household expectations. New Zealand's central bank offers a strong model with simple, transparent, and messaging that builds market confidence.
Thank you all the panelists for sharing valuable insights. It's clear that while small economies may not implement unconventional monetary policy in the same way as advanced nations, adapting the principle through communication, targeted support, and tailored intervention can still provide stability and promote growth. Before we conclude, let's summarize the broader implication of unconventional monetary policy. Now, I will give some few minutes to all the panelists to share their viewpoints.
Unconventional monetary policy is not a magic bullet, and Japan's experience with yield curve controls and negative interest rate policies shows that without structural reforms and supportive fiscal policy, results may not be limited.
Now, Joseph.
Communication is key, whether it's quantitative tightening or forward guidance. Market trust in central bank actions is critical to success.
The main reason is that unconventional tools like quantitative easing are powerful in crisis response, but they require careful exit strategies to avoid long-term debt traps and inequality.
Thank you all the panelists.
And now to discuss the differences between the unconventional monetary policy that we have discussed till now. Number one, quantitative easing. Quantitative easing is a large-scale asset purchases to lower long-term rates. Negative interest rate policy is setting nominal rates below zero to encourage lending. Under yield curve control, central bank targets specific yields on government bonds, and under forward guidance, communicating future policy intention to shape expectation. Now, to discuss with benefits, quantitative easing stimulates economy when rates near zero and lower borrowing costs. And for negative interest rate policy, it encourages bank lending and lower borrowing costs further. Number three, yield curve control anchor long-term interest rate, reduce market volatility. Now to discuss with the drawbacks, quantitative easing slow unwind, risks of asset bubbles, and under negative interest rate policy, it limited room to cut rates further, and there is a risk of bank profitability hit. Number three, yield curve control. There is a risk of bank distortion challenges in existing policies, and lastly, forward guidance. It requires high credibility, less effective if economic outlook changes.
Thank you all the panelists. Now to summarize what we have discussed till now, quantitative easing stabilizes market but can widen financial inequality. A negative interest rate policy encourages lending but needs financial support. Forward guidance helps market stability but requires credibility. For small economics, modification of this policy work better than direct adoptions. Exploring target lending, liquidity support and clear policy guidance may be more effective. And thank you to all our panelists for these discussions, and we hope this session provide meaningful insights into unconventional monetary policy, tools effective and their implication. And thank you all for watching this video, and hope to see you all in our next video. Till then, thank you and bye.
Thank you for watching.